Good morning, good afternoon, and good evening to you all of the Smoking Barrel Nation. I'm Rustin Edwards, based in Geneva, with my cohort in crime, that man of the hour, the man of the desert, Mr. Matt Stanley.
Greetings, one and all.
I should become a fight promoter.
Better than I was this time last week, and not as sharp as I should be for a Monday. Let's put it that way, okay? Writing my Christmas list. I'm being a good boy this week. Yeah, big week. Thanksgiving's up and coming. Black Friday. I mean, November seems to be Black November now. I mean, it just, people are trying to push retail on so many people. But my wife has ensured that we buy every single piece of Amazon stock in the UAE because we've just cleared out all their warehouses.
Well, you need to get some of those like mystery boxes they sell on Amazon.
Oh yeah, that's a good idea. Get your wife one of those, people. Let us know in January how that goes. All right. I'm not endorsing that. I've been happily married 20 years. It's just taken me 2 wives to get there. But anyway, hey. Let's move on.
Hey, how y'all doing today? Matt will be here on Tuesday, twice on Thursdays. Don't forget to tip your waitresses.
Right. This is an energy podcast, not a council session.
Yeah, but you could say that about trying to get the Christmas spirit of the Christmas consumption going up and running. I mean, here in Geneva, they just opened up the Christmas market, which seems to be 3 weeks earlier than normal. I have to double check the history on that, but it just seems like, wow, that's an early start to the Christmas market. They're going to run all the way until November 24th or December 24th.
Look, I don't mind it. I love Christmas, and just before we do get started on to anything not nostalgic or usual alcohol fuel related stories, whatever they might be, the thing I love about Christmas is I try and replicate exactly what it was like when I was a kid and when my parents were young as well. What they were doing. It's just a nice time of year, and it's certainly, talking about a change in habits. The UAE, when I first moved here over 10 years ago, you struggled to find a Christmas brunch or a Christmas somewhere you could go and have a Christmas meal and anything that was vaguely festive. Now you're falling over yourself from tinsel in a supermarket. So, yeah, I think the retail fairies are out in force this year.
Yeah, well, I mean, the big thing is to see how well the consumer is feeling, because Black Friday is the day after Thanksgiving, which is Thursday this week. And that's always the big retail say. Then you have the new Black Monday, which is when they say all of the e-retailers put out their number. And that's going to be there's going to be very interesting numbers to see if they carry through on what actual consumer demand looks like going into the holiday season. I mean, there was an uptick in freight. Container freight picked up in price. Port throughput increased in the West Coast United States. It's not saying that the United States is the driver of global consumer demand, but it is 300 million people, or 350 million people who every once in a while try to go on a shopping binge. So it'll be very interesting to see how Black Thursday pays out, or Black Friday plays out this year.
Yeah, I agree. And it's, I just think what consumer spending in general looks like, regardless of pushes that the FCMG markets are trying to put on people. It's, I'd say again, this is crazy season here in the Middle East, especially Dubai. I was at the Gulf at the weekend, the race to Dubai. It was packed, and the hotels are packed. And, yes, it's an outlier when it comes to global growth or global indicators, but Dubai has done exceptionally well. And I think that's going to last. I don't think that the region here, or especially Dubai, needs to necessarily push it outright. But yeah, things are moving off the shelves, and things are moving.
The next big conference of COP28.
Yeah, next week.
Next week. So yeah, you guys are slamming it here in November. Bari Week.
Yeah, I know. Well,
Dubai Air Show and now COP28.
Yeah, well, the air show is Look, I mean, again, it's a sort of random. A random data point. What does the aviation industry look like? Arguably, still feeling the effects of COVID and the drop in demand, massive drop in demand. People couldn't go anywhere. It was only the start of this year where Chinese travel was allowed again. So it seems like a distant memory now, but it was the busiest Dubai Air Show. It's only been going, I think, since 2005. 1,400 exhibitors, and there was $200 billion worth of deals between Boeing and Emirates and Wizz Air and et cetera. It was exceptionally busy, and people are spending money, and people are forecasting higher and higher tourism numbers. So look, if you were to look at that as a sort of standalone data point, as I said, you can kind of understand why the airline industry is feeling bullish about the future.
Well, you also have, they're projecting right now this Thanksgiving will probably be one of the largest traveled Thanksgiving holidays in a while, mainly again because of the COVID breakdown in the U.S. as well as in Europe. A lot of people are going to they are projected to be traveling based on forward ticket sales. And also,
Yeah.
this is the last big bastion of gasoline demand going into the year as well, because usually it's Thanksgiving is a driving holiday for a lot of people.
Yeah.
You got to go drive and visit grandma, then go visit the
Auntie
other
Mabel
grandma.
and Uncle Clancy. Yeah. Sorry.
So it'll be a big picture on what actual petroleum demand looks like going into the holiday season, because there is the drag of higher interest rates, higher credit card debt. Are they going to save money to buy Christmas gifts, or are they going to actually do travel?
Yeah, I mean, look, I go back to the COVID word, and stereotypes aside about going to see Uncle Clancy and that. I would argue that the post-COVID, I want to go and travel and see everyone and have that sort of conviviality that we all missed out on so much when people were locked down. I think that's still there. I think it's probably the last season. Sorry,
Last
yeah, I'd say
yeah.
so. And then I think 2024. I think you will see a lot of people go, well, that was good. We had a good 2023. We went on holiday. We went to go and see Nanny and Granddad. And we had a very nice Christmas. But now kids, it's time to eat dry toast and drink out of the well again. Maybe not that bad. But, nice segue there, Russ, onto gasoline demand in the US, because last week we saw quite a bit of volatility in the oil markets. We'll touch on that in a minute, I know. But just starting on gasoline demand looking weak. Hopefully Thanksgiving and the holiday season will increase global mobility and people getting cars, and hopefully a barrel of gasoline's a barrel of gasoline is a happier place to trade. But we saw huge builds on US crude stocks last week. Now, my colleague Matty Smith wrote a very good article. You should check it out. But there was a catch up, because the week before, the government, the EIA, the Energy Information Administration, that in the States had a planned system upgrade. So they didn't release any data for the week before. But we had a build last week of crude that showed up for the previous 2 weeks of 17.5 million barrels, which is huge. Now,
but if you break that down, just for all practical purposes, it was about a 13.5 million barrel build the week prior, and this week was only a 3.5 million barrel build. They do break it down a bit, but it still showed a huge build of crude oil, regardless how you want to shake it.
Yeah, I mean, look, it's this time of year as well. I think this is the seasonality of what we do. The energy market does, is that you would expect crude stocks to start drawing, because refineries are coming out of maintenance and they're pulling crude oil. But with the crack margins or refining margins, the cracks looking so weak, people are slower to sort of, come out of the refinery maintenance hibernation and start running refineries as they were. So inevitably that means that not enough crude is being run, which means crude builds, and that just weighs on sentiment. And look, that coupled with some relatively weak data out of China, we saw Brent drop to, what was the low on Thursday? 76.60.
Well, and there is a case that the market has been, gasoline has been the laggard in the United States. I mean, you had the four main independent refiners: P66, Marathon, PBH Energy, and Valero. All talk about how they're not going to run hard in Q4, and cumulatively, they're talking about a 400,000 barrel a day run cut for Q4, just because gasoline stocks are starting to build up inside of the PAD 3, PAD 2. If you start seeing gasoline stocks building there, you've got lower distillate demand here in Europe, which, despite what you might see on the gas oil curve, French gas oil demand is down 14% year on year. German gas oil demand is lower. Part of the reason why you have strong gas oil in Europe is the fact you have refinery operating issues inside the Lower Rhine Valley, which is keeping demand there tight. So our supply is tight, therefore causing a demand pull on German grade gas oil. Which you think the one thing the EU would do is say standardize what gas oil is across the board and forget having all these different country specs.
Yeah. Well, exactly. I mean, you know, the interesting part is that going back on our data, on Kepler data, we've got global onshore crude inventories, so barrels in tank, in storage, the lowest level since our records began in 2017. Now, they have bounced back from the first half of October by about, well, take the US and China, which account for just over half of global crude storage capacity, global crude oil stockpiles. So China plus India, China plus the US, excuse me, is about 55%, something like that. Now, they have built since the early October just over 40 million barrels between them. 40 million barrels, that's not bad. Is that because they saw, you know, China were running so hard, sort of Q3, and now they're not, and they see flat prices relatively cheap? I don't know. There's many reasons why, but
Well,
global.
I think it has to do, at least in my mind, the Chinese build has a lot to do with the fact that they bought a lot of crude when crude was cheaper, when crude was in the 70s and the 60s back in August, June,
Right.
July, and those cargoes have arrived against a lower refining run market because they don't have any more export quota. And
Yeah.
so where does the crude go? It goes into storage, and you build storage, and you build stock.
Yeah. Yeah, right. It's you know, it's just 2023 has been a sort of it's not as I would say patterns in terms of from a seasonality point of view have changed somewhat. Whether that's a low base, and we're going to argue about this all the time because COVID skewed so much of the sort of 5-year historicals, you know, is up for discussion, which we do on a weekly basis.
Well, it's interesting that you talk about inventory levels, because I think a lot of people put a bit too much stock in historic inventory levels, 5-year bands, versus a demand destruction environment that we're in going forward. I mean, I'm a believer that at some point we are living peak oil demand. Call it what you want. Am I going to call it today or call it in a month or two? Who knows? But we're in a peak oil demand scenario. Why do I say we're peak oil demand? We're probably at 102, 103 million barrels a day for the next 15 years, maybe next 10 years.
Okay.
We're probably not going to see much more increase above that, because every new piece of industrial demand that comes out, your ships, your cars, your trucks, your rail, your airplane, are far more fuel efficient than the ones that they're replacing. Number two, you've got the EV penetration. And that's a lot of EV cars, as well as EV bikes, EV scooters, EV tuk-tuks. No matter where you're at in the world, electric vehicles are making huge inroads around the world, causing, again, lower demand profile when it comes to consumer fuel demand. And so if you're looking at 5-year inventory, saying, oh my God, we don't have these inventories that we had before. Well, higher financing costs make it harder to hold inventory. And right now, yes, at 5% interest rates, you don't want to own inventory. Lower demand profile makes it harder to hold inventory because you now have capital locked up that you can be doing other things with. Yeah. So we could be seeing a point where the relevance of inventory stock levels don't mean much. I mean, when you think of gasoline, you know, why was gasoline so strong in the summer? Oh, PAD 1A. Oh my God, PAD 1A. Oh my God, there's so little gasoline in the New York Mercantile Exchange. Oh my God. Yet we've been actually running in the United States at a 400,000 barrel per day deficit on demand versus 2019 levels. And you didn't have mass stockouts. You didn't have mass runouts. So what's the relevance?
Your EV tuk-tuk thing analogy cracks me up. Those things only go 6 miles an hour. Then hardly the bellwether for oil demand. But anyway, as you say, so I'll buy into it as well. Look, I think that's
I got a Tesla.
Yeah, exactly. You're the issue, Greta. No, sorry. It's an interesting point, actually. Are we at peak oil demand? Does it actually matter? I'll tell you what the interesting part about that is, and we had this same discussion, argument, disagreement last week. If you are an oil refiner, you are not investing in Europe. You are not investing in North America, Canada. You are going to places. Where is the growth coming from in the oil refining sector, right? And we've spoken about this a lot over the last 12 months because we see it as such a sort of seismic shift in what happens when it comes to things like what the Dangote refinery means for the wider trading community, the New Duqm refinery, Jizan, Al Zour. The demand growth is not coming from the mature economies or sectors like North America and Europe. It's coming from the growing middle classes like West and East Africa, like the Middle East, and like South Asia. So, yes, I agree with you that peak demand on a global basis, we're probably about there. I would say maybe another 5 more years of growth, something like, but somewhat negligible when you're looking back historically. But if you're where demand drops off in Europe and the US because of the very reasons that you mentioned, not the electric tuk-tuk things, forget them, but other things as well that you mentioned, which were very valid, I see that will be offset by growth in the Mozambiques, the Ghanas, the Nigerias, the Saudi Arabias, which are still growing economies, the Thailands, et cetera, et cetera.
Well,
So I
if you
think
look at the GDP of Saudi Arabia, it's not. But
sorry,
if you look at the GDP of Saudi Arabia, it's not growing; it's contracting.
Look, I know you want to get onto Saudi Arabia. I'm gonna duck out of the call for about 10 minutes while you talk about that. No, but so yes, global peak oil demand. People like to talk about it. Are we there? Possibly. I think it's a valid discussion going into next year, and then the year after that. But I would say where demand is dropping off will be offset by places that are growing. So I see the positive side of that coin, to be honest.
Well, I mean, from a trade perspective, it's going to make things very interesting because when you think of all of the major trade hubs that have developed, they sit in the areas where demand is starting to wane. And so therefore, are we going to see a shift of, say, instead of having Platts Northwest Europe quotes, we're going to end up with Platts West Africa quotes dominating the pricing points around the world, because that's where the demand sits now. It doesn't sit in Europe. It doesn't sit in the US Gulf Coast. It doesn't sit in Singapore.
Yeah,
maybe Singapore's still there because of the relationship to India, Asia, China, Australia. But
yeah, but the oil market is a belligerent one. It's the fat London banker sitting in the corner still smoking a cigar at lunchtime. That's Brent, the global the oil benchmark. Brent doesn't produce anymore, right? But it's kind of a legacy thing. I think it's again a very interesting point, and one we're going to go into when we talk about what the year to come is in 2024. Will we see benchmarks shift, moving in line with market patterns, with where demand is growing and where it's going to come from? I think it's a nice idea, and I think that would be extremely visionary for a Platts or an Argus or whoever else is going to cost you $1 grillion a week, whatever they cost, friends of the show. So yeah, it will be interesting to see if that happens. I'm not sure it will, but the more that flow is shifting and is coming out of places like the Middle East and West Africa with the Centura refinery in Ghana and the Dangote one in Nigeria, I think it's kind of inevitable.
Yeah, I would agree. You have to have the market move, or the market information move to where the actual demand is, not linger in the doldrums of markets that are not as relevant as we move in the future. But speaking of relevance, Matthew's going to go and take a break.
Nice seeing you.
So we had a big rally on Friday when it came to flat price, up $3, and of course it had to do with the spectral headline of OPEC is looking to cut 1 million barrels. And so it comes back to say, last week we had, or over the last 2 weeks, we had OPEC, EIA, IEA, EIEIO all come out with their progressive forecast of 2024 demand. And there has been, again, a big divergence between what the OPEC forecast has on forward demand versus what the IEA and what the EIA have, as well as a lot of banks. If you look at the OPEC demand, you would say that, oh my God, we don't have enough crude. This market is so tight going forward. And if you listen to what the OPEC oil minister says, that yes, market demand is so wonderful, so phenomenal, it's so great. When you look at everybody else's analytics, stock builds out until Q2, end of Q2 is the big theme. And as you guys pointed out already in your data, you see stock builds already has started to happen, 1 million barrels a day roughly. If we built 40 million barrels in the US and China, that's 1 million barrels a day of stock builds. So it comes back to the rationale behind OPEC probably needs to fire their analytic team and put a real analytical team in there. And I'm saying this partly in jest, but also partly in that their actions don't speak to their actual data that they put out. Because if their data was showing so much stock demand going forward, why are they contemplating cuts?
Look, if you are a PR representative of a football club and everyone sees that you're not very good, you're not going to come out and say, we're rubbish, we're going to get relegated this year. You're going to come out and you say, well, I think we've got a chance of finishing mid-table or something like that. The very thing that OPEC represent, which is to balance market, supply and demand, have a look at market dynamics and adjust production accordingly for a third of the world's oil production, they have to, within the very fabric of what the group does itself, has to be bullish. It can't say, well, you know.
Well, I mean, you can be bullish, but you also have to be realistic, because what's the value of their analytics if they're saying that, oh, demand is 2.5 to 2.7 million barrels a day in 2024, and everybody else in the world says, no, you're wrong, it's about 1.3.
Look, would you rather be an optimistic pessimist or a pessimistic optimist?
Well, look at it like this. If they actually had better forecast forward analytics on true demand, then making a cut today would actually make sense.
Okay.
Because they would say, hey, we see demand dropping off, therefore we are going to scale back, but then to balance the market. When they don't do that, and they make announcements regulated to a price move that they don't like, it throws their whole market balancing argument out the door, because they're reacting to price, not to forward analytics.
Okay, right. Now this is the Russ Edwards 10 minutes, all right? Matt Stanley not involved in this. Insert caveat down the bottom here. Read that one. No, look, it's a valid point, and you're right. And this is the argument that the market has when it comes to how the market views OPEC and what it's there for. Is it to balance supply and demand? We've seen recently that the people selling the market are not those looking at the real data, that demand is okay, and it's the algorithms who have been selling things off. Yeah, okay, they're a big part of the market, so that is
well,
always
wait.
a factor.
Is it algorithms, or is it actual traders who see the stock builds saying, we need to be in contango because, oh my God, there are stock builds all the way out to the end of Q2.
Right, exactly.
The market is actually reacting to forward analytics based on supply and demand balances. I don't think that's an algorithmic trade. I think that is a true trader trade.
I agree with you. So what is the group there for? Because up to now, we've only had the sort of defense headlines coming out, defensive about current policy, that demand is okay, it's all fine. But then Brent drops below 80, which is a crucial number for the OPEC group, especially the GCC core, you know, Saudi, Kuwait, UAE, et cetera, does it mean that the group are really only, when you see a headline, the article you sent me at the weekend, where they might come together at the end of the week and cut another 1 million barrels because prices are forcing their hand? Now, is it the data regarding demand, which is about how much they're going to produce, or is it that they're protecting flat price at $80 a barrel?
Well, I mean,
you'd argue the latter, right?
I would argue the latter, that they're more price sensitive than they are on actual demand fundamentals. I mean, their analytics mean absolutely nothing. They're bollocks. Their forward analytics are bollocks compared to the rest of the world, because they're not reacting to their forward analytics. If they trusted their forward analytics, saying, oh my God, there's so much demand in the market, there'd be no cuts. They would be producing max production, because there's a supply deficit of I think 1.3 million barrels if you look at them. So they would add 1.3 back to the market.
Do you think the Smoking Barrel will be invited to Vienna at the end of the week then? You're all bollocks. Can we move on quite swiftly, please?
Hey, if you're not willing to look in the mirror and tell you're wrong, then
I haven't looked in the mirror for the last couple of weeks. It's been a brutal period. Anyway, no, look, they're valid points. And joking aside, what is market perception of what the analytics of OPEC says? Does it make a difference? Does the market read the OPEC report on a monthly basis and react accordingly? I don't think it does.
Well, I think the algorithms do, because when the OPEC report came out, there was a massive move in the market. And that was, I think, more algorithmic trading than anything else. I mean, why did the market rally so much on that report saying, oh my God, demand is so strong, only to be knocked down when the IEA came out with their report saying, no, demand looks like crap.
Yeah, I mean, this is the thing. So we saw a drop. So I mean, last week was interesting. So at the start of the week, we opened at 82.52. We went down to a low of 76.60, and we closed at $81.08. A bit of a mere week, but you know, when we did go down to the 76.60, I think I would argue the majority of people were kind of expecting it, were kind of waiting for it. So the rally up on Friday purely was just by buying on the back of the OPEC will do something.
Yeah, and you saw that not only on the flat price move, but also on this change in curve structure, because the Brent curve had moved into contango, the TI curve had moved into contango.
Yeah.
And there was a tremendous amount of spread buying that happened in M1, M2, M2, M3, and in 3 and 4 to push the curve up, which also caused flat price to move up.
Yeah.
So it was a pure structural shift on the back of potential OPEC cut going into Sunday.
Yeah, I mean, you look at structure. So if I'm looking at the price, the front month now is January, $81.04, 12.47 on the 20th of November, and May is $80.45. That structure has really narrowed. That's come from a $3 or $4 spread, you know, between Jan and June, to being 60 cents.
Yep.
Yeah. I mean, what it means is that, you know, if you are an Aramco or a Saudi and you're looking at policy adjustments, you look further down the curve for Cal 24 next year, it's more or less above 80 across the structure. But I think structure will quickly go bid if more barrels are taken off the market. At the end of the week.
Definitely. But even if OPEC does cut 1 million barrels, headline number, they're already still underproducing by about 700,000 barrels a day against their quota. So is this an adjustment in the quota? Because at the end, who is actually going to cut? It's probably, you know, will Saudi cut another 200,000 in Kuwait and UAE and maybe Angola? Iraq. I mean, so you'd have to get a coalition of people who are able to cut, because a lot of your West African producers are not producing, or African producers in general are not producing at the levels established by their quota.
Okay, well, look, I mean, the other thing to be would, I mean, yeah, okay, on that, I don't think you will get an Iraq. Kuwait maybe 100,000 barrels. The UAE being forced into a position like that caused a lot of headlines a year ago in October, when they were like, you know, we're not going to do that, we won't be told what to do, etc., etc. So I think if you anything, I think you might see like an extra, I know the Russians and the Saudis sort of saying we'll cut another 500,000 each or something like that. But you know, as I said to you a couple of weeks ago, we forecast at the beginning of, or the middle of October, we sent out our crude oil forecast for next year. And that the Saudis will keep off their 1 million barrels a day until the end of next year. Now, is that the leverage you think the Saudis will use at the end of this week rather than any additional cuts?
The problem the Saudis have is that a lot of analysts agree with Kepler or your group on the Saudis keeping the cuts in place till the end of 2024. And so that's already baked in the numbers, and that's showing stock builds still.
But the Saudis haven't said it yet.
They haven't said it yet. But the rational analysts would say that's a very plausible situation, because we've got stock builds going into the end. You know, if we don't lose that, the stock build even gets bigger. So it's a case of, you know, you're in a negative economic growth market, you're in, or meddling economic growth, let's call it that, because the GDP numbers are skewed all over the place, but the PMI numbers still show big negative numbers. And there's a lot of PMI information that's coming out this week, basically from Asia to the United States. This whole week is PMI data. So you'll get a very good grasp of how well the manufacturing and service sector is going into November. But, you know, we're at that point where what can actually be done to curtail oil production? I mean, Russia is going into winter. And traditionally, it's hard to cut production in Russia going into winter because it gets cold. And same thing, shutting down refineries in winter, very hard to resume operations because it's cold.
Yes.
So it's a very, I think, unplausible for Russia to do anything else. They may say they're going to do something, but what would they actually do? Probably very little. I mean, they just resumed gasoline exports on Friday. So obviously they want to move product out as much as they can to revenue out what they can.
Yeah, I mean, I think what it is as well, I think, since July when the additional cuts were announced by the Saudis and, crude went back up to the sort of early 90s, the group, especially the voluntary cuts from Saudi, appeased what the market's concerns were, that you guys have to do something because no one else will, in terms of OPEC, market saying you do something because someone else will. This time the market seemed to sort of preempt it and buy it on Friday, thinking, well, flat prices just touched 77.
Yep.
I'm waiting for an OPEC headline. Bosh, out it comes. We might do something next week. If the group don't do anything, right, and I think this is the difference for the last sort of 3 or 4 meetings, then I think that the market sells off and sells hard.
Oh yeah, no, I think you're absolutely right. I think Monday, we will all walk in on Monday and there'll be just a big sell order coming in because the world is going to say we're oversupplied, we got to do something. So it is a case of, can the greater OPEC plus group do something? Do they have the willingness to do something? Or are they going to put that burden again on the back of Saudi Arabia?
Stay tuned. Actually, we're not doing anything next week, are we?
No, we're not. Unfortunately, we're not. We've got a bit of schedule. So next week,
Vienna.
No smoking barrel, unfortunately. So we'll have to see how that one plays out in the wash. But we are coming to the end of the year, so the week of the 18th is going to be our big end of the year finale.
It
what
will.
Went right? What was wrong? And how do we see 2024?
I'm excited. I can't. Should we wear Santa outfits?
Oh.
Why
would we even think of that?
Yeah, good point.
All right. Well, we've come to another end of another wonderful smoking barrel. We look forward to seeing you all on LinkedIn. Click like, comment, subscribe.
Yeah.
And we will catch you all later.
Ciao.